Welcome to the Byte-Size Brief. Today we are putting Allbirds, B-I-R-D, that's B-I-R-D, completely under the microscope. Let's get into it. We have a massive stack of sources in front of us today, fresh SEC financial filings, real-time insider trading logs, and some incredibly brutal Reddit threads from the brand's most loyal customers. Our mission for this deep dive is to figure out exactly how a premium, eco-friendly shoe brand morphed into a high-powered artificial intelligence data center essentially overnight.
Yeah, it's easily one of the most bizarre corporate transformations we've seen this decade. To really understand the sheer magnitude, and the underlying risk of this shift, we have to look at this story in two distinct phases.
Right.
First, we need to forensically examine the final gasp of their retail footwear operations. We have to look at the financial foundation they were standing on just weeks prior to this announcement.
Makes sense.
And then we have to analyze this sudden, explosive pivot to AI compute infrastructure. That's the specific announcement that sent the stock soaring over 500% intraday in mid-April 2026. Because you simply cannot grasp the danger of the new venture without understanding the absolute collapse of the old one.
Okay, so compared to last quarter, what actually moved the needle here? Because looking at the start of the year, it really felt like they were trying to signal a massive comeback.
On paper, they absolutely were. If we look at the fourth quarter of 2025, the numbers were, well, surprisingly optimistic. Their revenue came in at $60.2 million. Now, yes, that was down 6% year over year, but it actually beat Wall Street's estimates.
Okay, beating estimates is always a good headline, right?
Right, but the real story was their gross margins. They jumped significantly quarter over quarter, hitting 62.1%, up from 58.4%.
Wait. Nearly 4% jump in gross margins for a physical product company in a single quarter? That is incredibly hard to do when you are dealing with physical supply chains. How did they actually pull that off?
It came down to two major operational shifts. First, they drastically reduced their promotional discounting. They just stopped slashing prices to move aging inventory.
Oh, okay.
And the psychology behind that is vital. When a premium brand constantly runs sales, it trains the consumer to never pay full price, which destroys brand equity over time. By holding the line on price, they protected that premium perception and bolstered their bottom line.
Yeah, that makes total sense. You just stop training people to wait for a clearance rack.
Yeah.
So what was the second shift then?
Supply chain domestication.
Right.
They shifted 40% of their merino wool sourcing directly to U.S. farms. That is huge.
Oh, wow, yeah.
By localizing that massive chunk of their raw materials, they completely bypassed the looming tariff risks on Asian imports. Right now, those tariffs are threatening to raise costs by 10 to 15% across the board for their competitors. Allbirds, B-I-R-D, basically built a defensive moat around their materials, which directly padded those margins.
Wow, so they were actually making smart structural supply chain moves. But with all that physical restructuring, did they actually manage to make any real money?
They did, surprisingly. They hit a positive adjusted EBITDA of $1.2 million for the quarter. And the board of directors felt so confident in this trajectory that they announced a $10 million share repurchase program.
A buyback.
Yeah.
That's a pretty strong signal.
In the financial world, a buyback is a powerful psychological tool. It's management's way of flashing a giant neon sign to the market saying, "We believe our stock is severely undervalued and we have the cash to prove it." On top of all that, they secured a massive multi-year wholesale partnership with VF Corp.
Wait, VF Corp, the giant retail conglomerate.
Yes, they were slated to get Allbirds, B-I-R-D, shoes onto the shelves of over 200 REI and Dick's Sporting Goods stores by the second quarter of 2026.
So basically, it's kind of like putting a fresh coat of paint on a house right before a hurricane. The numbers look decent, but was it just a mirage for regular investors?
I'd actually push back on the mirage idea. It wasn't an illusion. It was a desperate, mathematically sound Hail Mary that simply ran out of time. They pulled the right levers to fix the balance sheet, but the core business model was fundamentally collapsing under its own weight.
Because of the retail source.
Exactly. The brick-and-mortar retail strategy was bleeding cash faster than the supply chain efficiencies could save it. In January 2026, Allbirds, B-I-R-D, had to face the music and announce the closure of all the remaining full-price U.S. stores.
All of them.
All of them. They retreated entirely, pulling back to just their e-commerce platform, their wholesale partnerships, and leaving open only a couple of outlet stores and 2 international locations in London.
Man, that is a total surrender on the physical retail front. You don't just board up your entire domestic flagship retail footprint if the brand is actually healthy.
No, you don't. And the context of the broader footwear market makes this retreat even more devastating. Let's look at the competitor landscape as a benchmark. While Allbirds, BIRD, was struggling to eke out a meager 5% growth in their running shoe category, competitors in the exact same market conditions were thriving.
Like who?
Look at Hoka, for instance. They are absolutely dominating the cultural zeitgeist right now, surging 25% to hit $500 million in quarterly sales. They are capturing the exact premium, comfort-focused demographic that Allbirds.
Right, but what does all that actually mean for Allbirds, BIRD investors?
It means your company is rapidly losing its market share and its cultural relevance. And if you look at the source material, that financial decay was perfectly mirrored by consumer sentiment on the ground.
In what way?
Well, if you go into the hardcore communities on Reddit places like r/Allbirds and r/OneBag, where the brand's most loyal early adopters hang out, the feedback was brutal. Customers were reporting undeniable drops in product quality.
Brutal how? Like, what kind of quality drops are we talking about here?
We are talking about people posting pictures of pinholes developing in their tree dashers after just a few gentle washes. Complaints about premium $150 shirts simply falling apart at the seams.
Oh man, that's terrible for a premium brand.
It is. And here's why that is so fatal. When your entire brand identity is built on sustainability and making things better for the planet, producing garments that effectively become disposable fast fashion after a month of wear is a death knell. You completely shatter consumer trust.
Yeah, that is brutal. You lose the hardcore fans, the evangelists, and the whole house of cards just comes down.
Which brings us to the absolute bombshell hidden in their recent 10K filing. Because of this total collapse in consumer demand and retail viability, management's auditors forced them to issue what's called a going concern warning.
Okay, let's unpack that for a second. What exactly does a going concern warning actually do?
In the accounting world, it is the auditor essentially ringing the emergency alarm for investors. It legally states that there is substantial doubt that the company can survive and continue operating for another 12 months. It is the precursor to bankruptcy.
Wow. So it's basically game over.
Essentially. In response to this stark reality, the board agreed to sell the entire Allbirds BIRD footwear brand, the intellectual property, and all its physical assets to the American Exchange Group for a mere $39 million.
Hold on. How does that actually affect Allbirds BID stock price for regular investors like me? I mean, they went from a $4 billion peak valuation a few years ago to a $39 million fire sale. That is practically a 99% wipeout.
Yeah.
And wait, I'm looking at these filings here. CEO and CFO are getting $900,000 in retention bonuses just to oversee the funeral.
As shocking as it sounds to a retail investor, yes. The board approved an executive retention plan right before the sale. CEO Joe Vernaccio is receiving a one-time $500,000 payment, and CFO Ann Mitchell is getting $400,000, specifically to stay on through the closing of this asset sale.
How is that justified? The ship is sinking, and the captains are getting paid extra to watch it go down.
Well, from a corporate governance perspective, boards argue that these bonuses are necessary to prevent executives from jumping ship during a crisis. If leadership abandons the company during a fire sale, it could result in a chaotic, unmanaged liquidation that destroys whatever tiny fraction of value is left.
I guess that makes sense logically, but still.
But I completely agree with your outrage. From the perspective of an early investor who has watched 99% of their equity evaporate, seeing nearly $1 million handed out to the architects of the company's final days is incredibly difficult to swallow.
It is the ultimate insult to injury. You hold onto the stock, hoping for the turnaround they promised with those Q4 margin improvements, and you wake up to find the entire shoe company sold for scrap. But this is where the story goes completely off the rails, right? Because they didn't just liquidate, declare bankruptcy, and go home.
No, they didn't. Enter the mid-April 2026 pivot that completely shocked Wall Street. With the physical shoe business essentially sold off, the legal corporate entity of Allbirds, BIRD, the actual public company itself, still existed.
Okay.
And on April 15th, 2026, they announced they had secured a $50 million convertible financing facility from an institutional investor. They officially dropped the footwear identity, rebranded the corporate entity as Newbird AI, and entirely transitioned into a GPU as a service, or GPU as AI native cloud provider.
Wait, let me get this straight. So basically, it's kind of like a struggling bakery suddenly deciding to manufacture rocket fuel. I have zero infrastructure for this right now. Is this just riding an AI hype train to squeeze the stock, or is there an actual competitive advantage here?
The bakery analogy is spot on, and it explains the mechanics of exactly why an institutional investor would funnel $50 million into a dead shoe company.
Right. Why would they do that?
You see, taking a new tech startup public right now through a traditional IPO is incredibly expensive, time-consuming, and heavily scrutinized by regulators. But the Allbirds, BIRD, corporate entity, is already public. It's a hollowed-out shell that is already trading on the market.
Ah, I see where this is going.
The institutional investor is using the Allbirds, BIRD, ticker symbol as a Trojan horse. They inject the $50 million, instantly transforming this empty shell into a publicly traded AI infrastructure company, completely bypassing the traditional IPO process.
Okay, that makes the financial mechanism make sense, but what are they actually doing with that $50 million? What even is GPU as a service?
GPU as a service means they are buying the physical hardware that powers artificial intelligence. Their goal is to use this fresh capital to acquire high-performance, low-latency AI compute hardware, specifically top-tier GPUs from companies like NVIDIA.
Gotcha.
They put these GPUs in a data center and lease the computing power out to enterprise customers and AI developers.
But why wouldn't those AI developers just use Amazon AWS or Google Cloud? Like, why use a rebranded shoe company?
Because the massive hyperscalers, AWS, Google Cloud, Microsoft Azure, are effectively tapped out. The demand for AI compute power right now is astronomical.
Really, they're totally out of capacity.
Yes, spot markets for GPU access are incredibly unreliable right now. Furthermore, North American data center vacancy rates have reached historic all-time lows. If you are a mid-tier AI developer trying to train a new model, you simply cannot buy the dedicated long-term compute time you need from the big guys.
So they're stepping into a massive supply gap.
Exactly. Yeah. Newbird AI is claiming that because they are coming in with fresh, dedicated capital, they can acquire these high-end GPUs and act as a crucial middleman in this historic hardware drought.
And the market just completely bought into this narrative. I mean, looking at the charts, the stock went absolutely nuclear.
Nuclear is the right word. Depending on the exact minute you looked at the ticker on April 15th, the stock surged anywhere from 280% to over 580% intraday.
That is just insane.
It was a massive influx of retail traders, momentum algorithms, and speculators piling into what is now a microcap stock with a highly provocative AI narrative. When a company's market cap is beaten down to almost nothing, any injection of hype, especially AI hype, combined with a $50 million cash lifeline, can cause extreme, violent volatility.
It is pure speculative frenzy. But we have to step back from the glowing green numbers on the screen for a second. Let's look at the actual reality for you, the individual investor right now. Because if you are holding the stock through the shoe collapse, or if you just bought in on the AI hype hoping for a quick flip, what are the hard numbers and the actual risks you are facing?
Let's cool down the hype and look strictly at the mechanics of the risk, because the risk profile here is immense. First, we need to understand the reality of that $50 million lifeline. This is a convertible financing facility.
Meaning what, exactly?
Meaning the institutional investor isn't just handing them free money. They are essentially loaning the company money, but they have the legal right to convert that debt into equity, meaning actual shares of Allbirds, BIRD stock, usually at a very favorable discounted price.
Oh, so they can just print shares.
If and when that debt converts, they flood the market with new shares. That creates heavy, heavy dilution for existing retail shareholders. Your slice of the pie gets significantly smaller because millions of new slices were just created out of thin air.
Right. They're essentially mortgaging the future equity of the company to buy these GPUs today. That's a huge risk. What about the insiders? What are the executives running the company doing with their own personal shares while all this is happening?
That is the second massive red flag for anyone looking at this play. Prior to this massive AI pivot announcement, insider flow was purely negative.
Negative?
Yes. Over the last 6 months, CEO Joe Vernaccio sold over $33,000 worth of his shares, and CFO Ann Mitchell sold nearly $15,000. During that entire period, there was absolute zero insider buying.
Wow. Why is that such a critical metric to watch?
Because actions speak louder than press releases. If the leadership truly believed that a highly profitable, revolutionary AI pivot was just around the corner, you would typically expect them to hold their shares tightly or even buy more at the depressed pre-pivot prices.
That makes sense. You wouldn't sell if you knew a 500% pump was coming.
Exactly. The fact that they were strictly selling into the market prior to the announcement signals a profound lack of confidence in the underlying value of the equity.
Man. So they were cashing out their own chips while setting up the pivot. So what is the actual timeline here? How does this all physically unfold over the next few months for the people holding the stock?
Everything hinges on the upcoming special meeting of stockholders, which is scheduled for May 18th, 2026. The shareholders have to officially vote to approve both the asset sale of the shoe business to American Exchange Group and the $50 million convertible facility.
And if it gets approved?
If it gets approved, management anticipates issuing a special cash dividend in the third quarter of 2026 for stockholders who are on record as of May 20, 2026.
Okay, a dividend sounds nice, but how much are we actually talking?
That dividend would effectively be a final payout from whatever cash is left over from the $39 million shoe sale after all the corporate liabilities, debts, and executive bonuses are settled. It won't be much.
So if you are looking at your portfolio and holding Allbirds BIRD stock today, you are playing the ultimate financial gamble. You're essentially betting that the new capital from this $50 million facility and the potential scraps of a special dividend will somehow offset the total death of their core footwear business.
That's exactly what you're betting on.
Not to mention, you're betting that a corporate shell overseen by executives who ran a shoe company into the ground can suddenly successfully navigate one of the most complex, capital-intensive tech sectors on the planet with absolutely zero prior experience.
It is the definition of a high-wire act without a net. They have successfully used a Trojan horse maneuver to change their narrative from a failing retailer to a speculative tech play. But executing on that narrative requires flawless capital allocation and highly technical infrastructure management in a space dominated by trillion-dollar titans.
It really leaves you wondering, if a failing apparel company can rebrand as an infrastructure play just by buying GPUs with convertible debt, are we entering an era where the company itself is just a hollow shell and the only thing that actually matters anymore is the ticker symbol? All right, listeners, what's your take on the future of Allbirds? BIRD. Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.